Hi, thanks for tuning in to our MMG weekly recap. So, this week was crazy. Again, another March madness we had in the financial markets, and it's continuing into April. So, this week it was all about balance sheet runoff slash quantitative tightening. On Tuesday, Lael Brainerd got out in front of the Fed minutes and suggested that the Fed and the economy is strong enough to endure a quicker and more meaningful balance sheet reduction. So, what does that mean, balance sheet reduction, quantitative tightening? Well, we enjoyed the benefits of quantitative easing in the mortgage business for a couple of years where we were purchasing $120 billion worth of bonds every month. They now want to unwind that. So the opposite of quantitative easing is quantitative tightening and balance sheet reduction, where the Fed is, they said on in the minutes, they're going to assign a cap. And so every month, bonds will get the federal government or the Federal Reserve will receive their principal back when bonds either mature, maybe a loan gets refinanced as a purchase transaction, and so the Fed gets this principal back. They'll assign a cap. It'll get to 35 billion, which is double what it was when we modestly shrunk the balance sheet back in 2018. And so for the first 35 billion that the Fed would take in on principal return to them, they would give back to the Treasury, and then anything beyond 35 billion, they would actually go back and buy bonds, and it would gradually shrink the balance sheet by 35 billion a month in mortgage-backed securities and another 60 or so in Treasuries. But we're reminded here at MMG when they did the balance sheet reduction back in 2018, it's a very different economy, and they only hiked rates 3 times before the bond market went nuts and said you overdid it. Well, on Thursday, Fed Bullard came out and said he expects and would like to see the Fed increase interest rates by 300 basis points. That's 12 25 basis point rate hikes between now and the end of the year. So listen, at the end of the day, we've seen mortgage-backed securities decline over 600 basis points since the Fed flip-flopped on inflation back in November of last year. And the Fed, up until now, has only hiked rates once, and they've actually been buying bonds as recently as this week. So the idea that they're going to hike rates 12 more times and do a meaningful balance sheet runoff is very, very tough talk, but now it has to become action. And unfortunately for us in the mortgage business, we have to watch this and listen to the Fed because they have the mic between now and the next Fed meeting, which is still almost 1 month away on May 4th, and it will make for a ton of volatility. And it means that the path right now of interest rates and bonds is lower in price and higher in yield, and a tough discussion to have with your clients. A couple of key levels that we're watching with in the Treasury market is now 280 on the 10-year note. And if we get above 280, we're on our way to 3.25, which is the peak back in 2018. And then next week will be a big deal for us. We have both the consumer-facing CPI index and the producer-facing PPI index, key reads on inflation, and then consumer sentiment. And that consumer sentiment number is one that us at MMG, we struggle with all this rough talk because consumer sentiment is currently at recessionary levels. And the idea that we're going to hike all this aggressively and tighten financial conditions even more than they already are into that doesn't make sense to us, but we'll see. Hope this finds you well. Have a great weekend. Enjoy the Masters and opening day of baseball. Bye now.